Three people walk into the same bank on the same day. The first has nothing in their account, technically negative $4 after an overdraft fee hit the previous day. The second has $100,000 distributed across checking, savings, and a modest investment account. The third has $5 million. And here's what nobody mentions. It isn't simply that these three customers receive different products or different interest rates. They enter through different doors. They sit in different rooms. They're attended to by different people, on different timelines, with different levels of authority to actually resolve their problems. Same building, same logo above the entrance. Three completely different banks. Let's introduce them. Derek is 34 years old. He works full-time in logistics, earns roughly the median income, and has been overdrawn 3 times in the past 6 months. Not out of carelessness, but because his rent and an unexpected car repair landed in the same week. His checking balance at this moment sits at negative $4. Tyler is 36, works in marketing, has held steady employment for 8 years, and has accumulated around $100,000 across his accounts. Enough to feel comfortable, but not quite enough to feel genuinely secure. James is 52. He sold a business 7 years ago. His investable assets total $5 million. All three of them bank at the same institution. And what unfolds isn't a story about 3 different banks. It's a story about one bank that operates as 3 entirely separate businesses, depending on whose name appears on the account. Derek pulls into a gas station, swipes his debit card, and it declines. He swipes it again. Still nothing. There's a line forming behind him. He's running mental arithmetic. Did the paycheck clear? Did the rent auto-pay process? What was that gym charge from yesterday? The numbers aren't adding up fast enough. The card keeps declining, and people are watching. Meanwhile, a $35 overdraft fee has already been silently applied to his account from a transaction that processed 2 hours earlier. Derek received no phone call, no warning of any kind, just an automated fee generated by a system that knows exactly one thing about his account. The balance is negative. Tyler doesn't encounter this problem. His checking balance rarely drops below $4,000. But last month, a vendor charge processed before his deposit cleared, briefly pulling his balance to $80. The bank sent him a courtesy text message. He transferred funds from savings within the hour. The fee was technically assessed, but when he called and asked, it was waived as a one-time gesture. Same overdraft situation, same bank, entirely different outcome. James's account cannot go negative. A personal line of credit is attached to it automatically, covering any shortfall at a privately negotiated rate well below anything publicly advertised. But the detail worth pausing on is this. James doesn't even know his account ever came close to negative, because if it had, his private banker would have called him personally before the system ever flagged it. The fee Derek paid for being $4 short structurally cannot exist at James's tier. Banks collect billions in overdraft fees each year. The vast majority comes from a small percentage of accounts that are chronically overdrawn, the same customers paying repeatedly for the privilege of being financially vulnerable inside a system that charges them for it. Customers at James's tier pay nothing. Not because different rules apply to them, but because the same rules are applied very differently. All three need to visit the branch in person on the same Tuesday morning. Derek arrives first, pulls open the heavy front door, takes a number from the kiosk, and joins 7 people waiting at the teller windows. Plastic chairs, fluorescent lighting, a muted television on the wall showing financial news. He waits 23 minutes before his number is called. The teller processes his deposit in under 2 minutes and calls the next number before Derek has finished pocketing his receipt. Tyler arrives around 11. The line is shorter. He waits 8 minutes, gets his deposit handled, and on his way out, a personal banker intercepts him to ask whether he'd like to schedule a quick account review. He says, maybe next month. The banker hands him a card. The interaction is pleasant, mildly transactional, and forgotten by both parties within an hour. James doesn't enter through the lobby. He pulls into a small private parking area on the side of the building, is met at a separate entrance by his private banker, walks past the teller line entirely, and is escorted to a quiet office on the 3rd floor. Leather chair. Coffee already prepared the way he takes it. The conversation isn't about a transaction. It's about a real estate deal he's considering, a trust structure his attorney is updating, and a foundation his daughter is launching next year. The actual transaction takes 2 minutes. The meeting takes 45. Same building, same brand on the door. Derek waited 23 minutes to make a deposit. James was served coffee while his banker handled the identical deposit in the background as a courtesy. Each of them needs to borrow money this month. Derek's transmission failed. He needs $4,500 to repair the car he depends on to get to work. He fills out a paper application at the branch, waits 4 days for a response, and is denied, not because the amount is significant, but because his credit score falls short. His account history reflects the recent overdrafts, and the bank's risk model classifies him as a high default probability. He's offered a secured card instead, one where he would deposit $500 of his own money to receive a $500 credit line. In other words, he would lend the bank his own money so the bank could lend it back to him at 24% interest. Tyler needs $20,000 for a kitchen renovation. He applies online from his couch on a Sunday evening. By Tuesday morning, he's approved at 6.9%. The process is automated, the paperwork electronic, and the funds arrive in his account by Wednesday. Fast, functional, and exactly the way most people imagine banking is supposed to work. James needs $2 million to bridge a real estate purchase before his existing property sells. He doesn't complete an application. His banker calls him, asks what rate works for him, and proposes terms negotiated in a single conversation. The rate isn't listed on any website, it isn't published anywhere, and it's lower than what Tyler was offered on a loan 100 times smaller. The price of borrowed money is lower for people who already have money. That isn't a metaphor, it's the literal mechanism. Derek was offered 24% on $500. Tyler was offered 6.9% on $20,000. James was offered roughly 4.5% on $2 million. The customer least able to afford borrowing is charged the most for it. The customer most able to pay is charged the least. This is how wealth compounds through the banking system before a single investment decision is ever made. Eventually, something goes wrong for all three of them. Derek notices a duplicate charge on his account. He calls the customer service number on the back of his card. The hold time is 34 minutes. The voice he eventually reaches is friendly, but reading from a script authorized to handle only standard issues. The duplicate charge requires escalation. Escalation requires a callback in 3 to 5 business days. Derek hangs up not knowing whether his money will be returned. Tyler calls about a fraud alert that froze his card while he was traveling. Hold time, 6 minutes. The agent speaks with him directly and unfreezes the card within the same call. The problem is resolved before he finishes lunch. James doesn't call customer service. He isn't sure he even knows what the customer service number is. When something requires attention, he sends a text to his private banker, who responds within 10 minutes, often within 1. No script, no escalation queue. The person on the other end has full authority to resolve the issue immediately because the entire structure of the relationship is built around ensuring James never experiences friction. Derek calls back separately to ask whether the bank will waive his $35 overdraft fee. He explains the paycheck timing, explains it was a small charge. The agent is sympathetic, but reads from a screen that says, "The policy is the policy." He pays the fee. Tyler mentions a wire transfer fee to his banker, who checks his account profile, notes his average balance, and waives it as a courtesy. Tyler thanks her and continues with his day, vaguely aware the system bent slightly in his favor without much effort on his part. James never asks about fees. The charges that technically apply to his accounts are waived automatically before they ever appear, removed by people whose entire function is to anticipate friction and eliminate it before it surfaces. Exceptions that would require manager approval at Derek's tier are resolved before any manager is consulted at James's tier. Same written policies. Completely different discretion in practice. Banks don't bend laws for wealthy clients. What they do is exercise every legal degree of flexibility available under their internal policies in favor of the clients whose relationships are worth preserving. That discretion is the entire difference. The rules don't see all three are looking at properties this year. Derek hopes to purchase something around $250,000 using an FHA loan with the smallest down payment he can manage. Given his recent overdraft history, his application is conditional. His rate comes in at 7.8%, and he's required to carry private mortgage insurance because his down payment falls below 20%. Over 30 years, on a $240,000 mortgage, the total interest he'll pay is roughly $381,000, nearly two-thirds of $1 million to borrow $250,000. Tyler is buying a $500,000 home, putting 20% down. His rate, based on his stable income and credit profile, comes in at 6.3%. Over 30 years on a $400,000 mortgage, his total interest is approximately $490,000. Higher purchase price, lower rate, lower cost per dollar borrowed. James is acquiring a $4 million property. The rate his bank offers isn't listed anywhere publicly. After a brief negotiation, he closes at 4.6%. Over 30 years, on a $3 million mortgage, his total interest is roughly $2.5 million, which sounds enormous, and it is. But per dollar borrowed, James pays less than half of what Derek pays. Derek pays approximately $1.59 in interest for every dollar he borrows. James pays roughly 83 cents. The customer who can least afford it pays the most. The customer who can most afford it pays the least. This isn't a flaw in the system. It is the system. The bank isn't acting with malice. It's pricing risk. But the practical result is a structural transfer of wealth from people borrowing expensive money toward institutions lending cheap money to people who don't genuinely need to borrow it in the first place. Hang. The willingness to apply them generously does. All three are looking at properties this year. Derek hopes to purchase something around $250,000 using an FHA loan with the smallest down payment he can manage. Given his recent overdraft history, his application is conditional. His rate comes in at 7.8%, and he's required to carry private mortgage insurance because his down payment falls below 20%. Over 30 years on a $240,000 mortgage, the total interest he'll pay is roughly $381,000, nearly two-thirds of $1 million to borrow $250,000. Tyler is buying a $500,000 home, putting 20% down. His rate, based on his stable income and credit profile, comes in at 6.3%. Over 30 years on a $400,000 mortgage, his total interest is approximately $490,000. Higher purchase price, lower rate, lower cost per dollar borrowed. James is acquiring a $4 million property. The rate his bank offers isn't listed anywhere publicly. After a brief negotiation, he closes at 4.6%. Over 30 years on a $3 million mortgage, his total interest is roughly $2.5 million, which sounds enormous, and it is. But per dollar borrowed, James pays less than half of what Derek pays. Derek pays approximately $1.59 in interest for every dollar he borrows. James pays roughly 83 cents. The customer who can least afford it pays the most. The customer who can most afford it pays the least. This isn't a flaw in the system. It is the system. The bank isn't acting with malice. It's pricing risk. But the practical result is a structural transfer of wealth from people borrowing expensive money toward institutions lending cheap money to people who don't genuinely need to borrow it in the first place. Derek's bank doesn't know his name. He is an account number in a database. The system is aware of his balance, his transaction history, and his risk score. It does not know that his sister has been unwell, that his car repair was unavoidable, or that he is actively trying to do everything right. The bank's interest in Derek is entirely automated. In their internal language, he is a cost to be managed. Tyler's bank knows his name when he walks in. He occasionally receives generic emails about products he might qualify for. If he called and threatened to leave, someone would probably attempt to retain him with a modest offer. He is a customer in the way any business values a customer, appreciated while present, replaced without ceremony if he goes. James's banker knows his children's names. She knows about the foundation. She knows what he is building and what he is trying to protect. His relationship with the bank is a named line item in someone's performance review. Losing him would affect her career, her team's numbers, the regional manager above her. At this level, he is not a customer. He is a relationship. And that single word, relationship, is the entire difference between being served by an institution and being processed by one. If you're in Derek's position right now, the system is actively charging you for being where you are. The path forward is uncomfortable but real. Stabilize your cash flow, eliminate high-interest debt, and raise your balance above the threshold where the bank stops penalizing you simply for existing. If you're in Tyler's position, the system is treating you fairly, but your balance isn't yet large enough for the institution to genuinely compete for your business. The leverage shifts meaningfully somewhere around the $250,000 mark and accelerates from there. Here's what nobody at any tier tells you plainly. The bank is not your friend, and it is not your enemy. It is a business that prices you according to the value you generate for it. Understanding that, truly understanding it, is the first step toward using the system rather than being used by it.